I am pleased to report that members of the FOMC are unambiguous and unanimous. This committee will deliver price stability.
Hello and welcome to the week ahead on Nomura Podcasts. My name's Dominic Bunning, head of G10 FX strategy at Nomura here in London, and today is Friday the 19th of June. Well, what a week it's been in financial markets. The signing of the US-Iran Memorandum of Understanding on Wednesday was clearly overshadowed by the first FOMC policy meeting held under new Fed Chair Kevin Warsh, who you heard from at the top of the show. The meeting, the information released around it, and Warsh's press conference all caused a big hawkish reaction in markets, with yields bouncing on that hawkish message and on the lack of forward guidance, and the dollar jumping to multi-month highs. The most obvious takeaway from all of this was that the Fed is going to be changing how it does things, with less forward guidance and with task forces set up to look at a range of topics that are at the heart of the Fed's business. We'll discuss these changes with special guest John Cohn, our US rate strategist, and with David Seif, our chief economist for developed markets. Central banks have also been pretty exciting in Europe, with George Buckley joining us to discuss our two big changes in view for the ECB, where we've turned more hawkish, and the Bank of England, where we've turned less so. Finally, Yuban Parashueles will be on to talk all things Asia, but most notably look at the upcoming Bank of Thailand decision and to review recent events in Indonesia, including two back-to-back rate hikes. So that's plenty to get stuck into this week. Let's get on with it.
At any institution, a change in leadership is a natural and timely opportunity to reaffirm its mission, to review current practices, and to consider whether those practices best meet our objectives. My Fed colleagues and I will be working in close collaboration to ask what changes might improve the conduct of monetary policy.
Well, we're going to kick off this week in the US, where we start with a very special guest speaker, John Cohn. John is our US rate strategist based out of New York, and I must make it clear here that he is not a member of the research team, but rather one of our desk strategists. So with that crucial bit of compliance out of the way, John, let's get stuck in. Thanks a lot for joining us. Let's start pretty broad. What did you make of the market reaction for this meeting? There seemed to be some pretty big reactions in rates and in FX markets, actually. It was almost like the market was caught off guard a little bit.
Yeah, thanks, Dom. Good to be back. And you're spot on. The Treasury curve saw a massive flattening on a more hawkish meeting result. We saw the removal of forward guidance. We saw a dot plot with officials split on hikes by year end. We saw higher core PCE inflation projections. And in his press conference, Warsh really emphasized price stability. All of those things contributing to a meaningful reassessment of the implied policy path, especially through year end. We're now pricing about 1.5 hikes by December. And that flattening has been a bit of a pain trade as well, which didn't help as the move just extended through it. Ahead of the meeting, there was concern that Warsh would come off dovish on rates, or at least, I think, resistant to hikes, perhaps even hawkish on balance sheet, given his previous comments. Clearly, that did not happen, and 30-year yields ended actually lower on the day, and have extended that move through Thursday. Alongside the decline in inflation break-evens, this, I think, likely reflects Warsh's strength and credibility on price stability, as well as the consequent decline in term premium resulting from that credibility. That sentiment supports what has been, I think, good sponsorship of the long end recently, even as uncertainty in the front end remains very elevated. Otherwise, as expected, the pullback in guidance, Warsh's general bias to offer less information, supported implied volatility along the policy path.
Yeah, I mean, that was one of the most obvious changes you mentioned, that's already been implemented. The forward guidance has been removed, and Warsh seems to want to make markets a lot more responsive to the data rather than to what the Fed's saying. How do you actually see that playing out?
It's fascinating. Warsh seems to want to short circuit the feedback loop between Fed's guidance and market pricing. Instead, giving the market more freedom to move in response to data, as you said, rather than in response to the kind of expected Fed reaction function. This would presumably confer some kind of benefit to the Fed, assuming the wisdom of markets exceeds that of policymakers. It would also allow the market to better self-regulate financial conditions. I think especially in periods of elevated uncertainty where forward guidance can and has actually been counterproductive. Remember COVID, when the Fed's projection of cuts after hikes kept financial conditions easier than they probably should have been. That's an example of that counterproductivity. And we actually saw the benefit of a more market-led path in recent months when the Fed de-emphasized its dovish bias and allowed the market to tighten for them, as all of the geopolitical and economic uncertainty required a more dynamic change in financial conditions. Now, I don't think that this feedback loop can be completely broken, and I don't think it should be. Markets won't just ignore the Fed, and the Fed may at times disagree with the market. Really, there's a deeper tension here between Warsh's desire for the markets to lead and the role of the Fed itself. It's like trying to observe a system you're part of. The Fed can't step outside and just watch markets price some objective reality when the Fed itself is an essential variable. The observer and the observed are part of the same system.
Yeah, I mean, it's going to be fascinating to see how that plays out. Like you say, really an interesting development. I guess, more broadly, Warsh clearly has plenty of ideas about reform. He's got his task force going on, emphasizing this transition to a new regime. But he's also leading an institution which historically has been pretty slow to change. So we've already seen quite a lot of changes with the statement, with the guidance, etc. Do you think more change can come quickly, or is it going to take a long time?
On institutional change, like you said, the Fed tends to move slowly and deliberately outside of extenuating circumstances. In getting his task forces up and running immediately, and with an eye towards having results from those task forces by year end, Warsh clearly wants things to get done faster than usual. We have some idea on what conclusions or recommendations he might favor given his previous rhetoric, things like less Fed communication, reworking or even discontinuation of the dot plot, de-risking the balance sheet, whether that's in nominal terms or in reducing the duration risk, and openness to productivity-driven disinflation. So we've got some idea, but it will still take time. There are plenty of practical and institutional speed bumps that they need to manage. And for now, Warsh is trying to build the institution he wants rather than chasing the rate path markets may have expected of him. I think that's the right call. He has few dovish cards to play at this point anyway.
Brilliant. Thanks, John. That's really, really helpful to get a gauge as to, how things are likely to change in the months ahead. And we'll sort of certainly keep checking back in with you to see how the Fed is moving towards those new goals and everything else. So thanks once again for your time, and we look forward to having you back on the pod soon.
Thanks, Tom.
Well, we're going to stay in the US now. We're going to hear from our Chief Economist for Developed Markets, David Seif. David, thanks a lot for joining us. We've already spoken to John about the FOMC, but absolutely keen to get your views as well. Clearly, the market had a pretty big reaction to the press conference, to the dots, everything else. I'm very interested in how much, if at all, that has changed how you're thinking about the monetary policy outlook from here.
Great. Well, wonderful to be back here, Dom. It was certainly a very interesting first meeting for Warsh. And I think when we look at everything in totality, certainly hawkish, no question about that. We would say that by far the most hawkish aspect of it, and arguably the only hawkish aspect of it, were the dots. Of the 18 submitted dots, Warsh, of course, did not submit one. 9 of them, or half of them, showed that at least one hike this year would be appropriate. Our expectations for the dot plot was more hawkish than consensus, but it was not this hawkish. And so the FOMC out-hawked us even on this. And so, that certainly was the lead-in. I will say that while neither hawkish nor dovish, we saw Warsh really leave his mark or make his mark very early by vastly shortening and simplifying the statement that the Fed released. Now, when it came to the press conference, that was arguably more divisive in terms of people's reactions. Our view was that it was actually slightly dovish. Not to say that the, again, meeting in totality was anything other than hawkish, but we don't think that Warsh was himself hawkish in the press conference. Now, he did come out and really metaphorically pound the table about the importance of price stability and the Fed's mandate. I don't see that as hawkish in and of itself. This is something that we would expect a new central bank head to do, to make it clear that this most fundamental aspect of what central banks are supposed to do is something that will continue on his watch. When we dig into the substance and all of the other things that he said, I would say that on balance, they were certainly more dovish than not. He talked about, for example, left of the decimal point, meaning that he's looking at the whole number for inflation, not necessarily what comes after the decimal point. And that implies, of course, that a 2.9 would be a 2, and therefore something that is acceptable. That's significantly higher than, of course, the Fed's actual 2.0 target. He talked about unevenness of how restrictive monetary policy is, or how easy it is right now, and really focused in on it being restrictive on the job market. He talked about maybe core versus non-core and just the general metrics in which that the Fed uses to evaluate inflation might not be something that will stay as they are. And of course, one of these task forces he announced will look into that. All of these things combined, especially also because he spoke about possible decline in inflation from the end of the Iran conflict, something that certainly will bring headline inflation down, we think, but really have a pretty modest impact on core inflation. All of these things, we think, really set him up to frame things in a pretty dovish tone. So, we did not change our view. Now, I think our view, which is that the Fed will hold rates steady for the rest of this year and 2027, is certainly more hawkish than many of our competitors on the street, but it is more dovish than market pricing. Our view has not changed. I would say that the balance of risks has shifted more towards the risks of hikes, and I would say can't even rule out a hike as soon as the next meeting in July, although that is very far from our base case. I would also say that we have to approach, and I think the market should approach, future meetings with a certain amount of humility. I think that we don't really understand what the Fed's reaction function is. It is something where, with Warsh talking so much about not signaling what the Fed is going to do, we've had more than 20 years where the Fed has operated under a de facto rule whereby it will, quote unquote, never surprise the market. And with very few exceptions, such as September 2024, that really has, there have really been next to no surprises from the Fed. That may not be the case anymore. I mean, many central banks are not like that. The Bank of Canada, the Bank of England, the RBA in Australia, all of them have shown a complete willingness to surprise markets. And listening to what Warsh said yesterday, it doesn't seem like he would see that as something that would be unacceptable, even for the Federal Reserve to do. We may be wrong that he's as dovish as we think. That was our view when he was appointed by Trump. It was supported a little bit by what he said in his Senate nomination or his confirmation hearing before the Senate. But perhaps we're wrong on that. We don't really have a huge amount of information on that. And then, of course, on top of everything else, even if we're completely right about how dovish he is, we think that although there's not a majority of the voting members, the 12 voting members on the FOMC, who had their dots showing a hike this year being appropriate, if we get a couple more hot inflation readings, we could easily get there. And then even if we're completely right that Warsh doesn't want to hike, he may not be able to stop it because, of course, he is just one of 12 votes. So I don't think it's crazy to see the market pricing in a reasonable possibility of a July hike. It is not our view that that will happen. Our modal view is unchanged, but we definitely recognize where the risks are at this point.
Yeah, fascinating, David. I mean, I see so much opportunity for volatility, for things to move around meetings, in between meetings. It will certainly become a much more exciting market, I think, for any Fed watcher and for anyone trading those assets. You mentioned there briefly the sort of core PCE number and the inflation prints. We do have a core PCE print this week. What are you thinking in terms of that number?
Yeah, we're thinking it's going to be another hot one, and that's really in spite of the fact that inflation was a little, at least core inflation was softer than expected from a CPI perspective when it printed earlier this month. We're expecting a 0.4. It is a round up to 0.4, so it's on an unrounded basis, it starts with a 0.3. And we're expecting on a year-over-year basis 3.5%, which will be the high print of this cycle. Again, it's a round up to that, but even if it only rises to 3.4, that would still be an increase from the 3.3% year-over-year that printed from April. And again, the high print of this sort of renewed increase in inflation cycle. Now, I will say, we think this is probably going to be the high print. I would say there's relatively symmetric inflation risk to inflation at this point, and therefore it wouldn't shock me to see another hot print later on, but nor would it shock me to see inflation come down a little faster than we think. But our base case is that it stays that it reverts to the low 3 handle and stays there into early 2027 on a year-over-year basis. That is well above the Fed's target, and of course, it's even if we only look to the left of the decimal point, it's even above Warsh's target from what he spoke about in the press conference this week.
Okay, brilliant, David. Like one other thing you touched upon in an early answer, and it's obviously the other big news this week, is the signing of the Memorandum of Understanding between the US and Iran. Do you think we've got to the point now where we can almost start to look past the Middle East when we think about the macro outlook, or is it still going to be pretty important to how you think about macroeconomics in the next few months?
Yeah, I would be surprised to see it looks like the strait is reopening as of when we're recording this. I would be surprised to see it close again prior to the November election in the United States. I think that it will be very hard for the U.S. and Iran to strike a sort of permanent deal, but I could easily see the 60-day limit being extended. So I do think that although we have to maybe not put it in the rearview mirror and just put it on the back burner, I do think that is we're going to see a resumption of energy and other flows through the Strait of Hormuz that will continue for the next number of months. Now, when it comes to economic growth, that's a great thing. It's good for the United States, although it's been our view that the Strait of Hormuz closure was less bad for the U.S. than elsewhere. Still, it's good that that's reopened. It's great for the rest of the world from a growth perspective. I don't think this is going to be, from a core inflation perspective, some sort of panacea for the United States. Our estimate is that about 0.1%, maybe 0.2% of the current well above trend inflation or above target inflation is due to the Middle East. We see only about a 10% pass through from energy shocks typically into U.S. core inflation. We raised our headline inflation forecast by about 1 percentage point due to the closure. That really, again, only translates to a 0.1% boost in core, even if you double it, 0.2%. It affects travel prices a little bit, which are in core, but most of it is stuff that the Fed is likely to look through. That said, I think that the dovish wing of the Fed, which we think Warsh is going to be part of, will use this as a rationale to head off rate hikes. And maybe that won't work. Maybe that won't work in general, and maybe it's not an argument that will play well for more than a couple of meetings. But it does seem like one of the best strategies in the short run, meaning over the next couple of meetings, to try to say to the hawks, hey, why don't we see what happens here from this and move forward? Again, not our view that it is of first order importance to the Fed's official inflation target, or what the Fed looks at, which is core PCE. But it is our view that some hawks may be convinced to hold off as we see what the benefits are from Hormuz reopening.
Okay, brilliant, David. That's super helpful. And we, as always, appreciate having you on the pod. So thanks a lot, and we'll speak to you soon.
My pleasure. Great to be back.
Okay, we're going to zip across the pond now and come back to London, but we're going to stay on central banks. We've got George Buckley, our chief economist for Europe, with us to talk about the ECB and the Bank of England. George, in the last week, you've changed both your ECB and your Bank of England forecasts. For the former, you've added in hikes. For the latter, you've removed a hike. Do you want to let us know what's prompted this? And also, why is there such a difference in the outlook for both of these central banks?
Yeah, thanks, Dom. And it's a good question. We have moved our views in different directions. We have 3 rate hikes now from the ECB, taking us to 3%. We've got no more hikes from the Bank of England. And, we did that in response to the 2 central bank meetings, the ECB a week ago and the Bank of England, well, today as we speak on a Thursday. The Bank of England made it pretty clear that they're not going to move preemptively. They're not going to raise interest rates for an insurance hike. They're going to need to see evidence of second round effects, higher inflation being passed through. I don't think that's going to come about because we're in a very different situation to 2022. If you want some justification of why we've raised the ECB view, the ECB thinks that current policy rates at 2.25 were probably still either well within the neutral range or possibly even for some members towards the lower end of it. So they now think the neutral range is between 175 and 250. So there's more that they could do, whereas the Bank of England's already there. It's already at the top end of neutral. So I think there's a number of reasons. The last thing I'd probably say is I think, if anything, there are downside risks to our ECB call and upside risks to our Bank of England call, as the markets would suggest.
Okay, thanks, George. That's very, very helpful. I mean, in terms of incoming data, it looks like it's a pretty quiet week, quite a lot of surveys, PMI data. What are you focused on when you're looking at those bits of data? Are you more focused on what's happening with activity, how that's picking up now that the war in Iran seems to be largely done, or are you looking at the price components and sort of looking for whether we're seeing any signs of a pickup in inflation?
Yeah, well, it's a very good question, Dom. And we have seen that this war has generated exactly what central bankers hate, which is a rise in prices and weaker activity. It makes it really difficult to know how to respond to that. It'll be both. I think we have to look at what's happening to the activity. This is exactly what the Bank of England said just at its meeting this week, that if you have a rise in prices, it is going to dampen activity. If you have weaker activity, it's going to pull down on inflation further ahead. If you have higher prices now, there is a risk of second round effects. It really is a nightmare for central banks when you've got this combination of weaker activity and higher prices. So we'll be watching out for both, and we get both. We get the PMIs, we get a number of other national sort of national country level surveys like the INSEE survey in France. I think we get the IFO survey in Germany as well. And we also get the consumer expectation survey. And within that, there is a very big focus on inflation expectations because they tell you where households think inflation is going to be in 1, 3 and 5 years' time. So all of those numbers are really important for next week.
Brilliant. Well, plenty to watch and plenty to see if those changes in views are going to be justified. Certainly from our side in FX, we hope to some extent that they are, because we've had a view to be more positive on the euro and a little bit more pessimistic on where sterling goes. So we'll see how that all plays out, but certainly interesting times for European central banks. George, thanks a lot.
Thank you, Dom.
We'll finish this week in Asia, where we've also got a range of central banks to cover. Yuban Parachueles, one of our other podcast hosts and chief economist for ASEAN, is with us. Yuban, thanks a lot as always for coming on. Look, there's been a lot of central bank talk already, but we'll do the same thing for Asia, and we'll start in Indonesia. I see the Bank Indonesia has actually hiked twice, I think, in the last 2 weeks. What's going on there? Why are they hiking so much, and what do you expect going forward?
Yeah, hey Dom, thanks for having me. BI delivered another 25 basis points hike this week. That's after an off-cycle hike also last week. So in total now, in a span of about a month, they've hiked by 100 basis points, which is relatively aggressive and really reflects the challenges of BI in containing significant pressures on the currency. And going forward, despite the US-Iran interim deal, we are still quite cautious about the balance of payments pressures in the near term, which could affect the currency further, including a widening in the current account deficit, which we expect. FDIs are also declining because of the uncertainty of government policies in Indonesia. And then, portfolio investment inflows have been much less reliable given the current global environment. And we've got some domestic concerns, including fiscal risks, which are obviously not helping. And actually, next week is quite a big week as well for Indonesia because we've got the MSCI decision on the 24th of June on whether to downgrade the equity markets there into frontier status. So that's something that we will all be watching for very closely. So where does this leave us? We have revised our BI forecast. We now expect an additional 50 basis points in hikes this year, although timing itself is still quite uncertain.
Okay, fantastic. I mean, clearly a lot going on there. I know our FX guys have had a pretty bearish view on the rupiah as well. So plenty of negative factors, but certainly be interesting to watch how they try and manage those in the weeks ahead. I guess next question is also central banks, but around Thailand, where we've got a BOT decision. Are you expecting any policy changes there?
Yeah, no fireworks with the BOT in our view. So we expect a neutral hold at 1%. The vote will also be unanimous. In BOT's case, they're still really seeing the increase in inflation as largely supply driven. So they're looking through that. And then if you look at core inflation, it remains very low and therefore not showing any signs of second round effect. So that's also reflective of domestic demand looking pretty weak in Thailand. In terms of the language, I think they will say that the policy rate at this level is appropriate, and it will suggest that any adjustment in either direction, a hike or a cut, is not warranted at this point. So for the rest of the year, we actually expect the BOT to stay on hold, and definitely not jumping on the hiking bandwagon in the region.
Okay, interesting. It's a bit of divergence playing out across Asia as well as what we've seen potentially in G10 as well. So certainly some parallels to be drawn there. Other than that, is there any other major data that you want to flag for us in the week ahead?
Yeah, a couple of things. So in Singapore, we have the core inflation data for the month of May, and we expect a rebound to 1.8 from 1.4. It looks low from global standards, but I think 1.8 in Singapore standards is quite high, and we think it's only going to continue to grind higher in the coming months, really reflecting some of the impact of the energy price shock, whether it's on food or airfares or holiday expenses. We think it's going to show up starting in May more meaningfully. And again, the economy is doing very well. Output gap is positive. Labor market conditions very robust. So we think there are some spillovers to the rest of the core basket. And then finally, in Australia, we've got the inflation numbers as well. We think it's going to tick up as well to 4.3 from 4.2 for the month of May, due to the jump in the new dwelling construction costs, as well as transport costs, which are again reflecting some of the impact of higher fuel prices. And then in labor markets, Australia will report its unemployment data, and we think the unemployment rate would be stable at 4.5, with employment rising by what we see as a sort of a trend like 20,000 for the month of May.
Cool. And I think from the RBA side, we're actually looking for rates to be unchanged there. So the data, probably the burden for a big shift is probably a little bit higher in terms of causing people to change their views on the RBA, who seem to be sounding quite comfortable with where things are at the moment. Great. Ewan, thanks a lot for being on, and we'll speak to you soon.
Yep, thanks.
Well, that's it for this week. Thank you, as always, for joining us on the Week Ahead podcast, which is produced and edited by John Dalton. Please feel free to share this podcast far and wide with anyone you think would be interested. You can like and subscribe to Nomura's podcast through all of the usual channels, such as Apple, SoundCloud, and Spotify. We'd also be grateful if you could leave us some feedback. Let us know what you like and what we can do better. You can also log in to nomuraconnects.com to keep up to date and to hear more on a range of topics. Thanks once again, and good luck for the week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, One Investment Bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.